One of my biggest pet peeves in recent years are the amount of TikTokers and Instagram influencers that are trying to peddle life insurance as a retirement strategy. I'm not saying that it cannot be used as a retirement strategy, but it's really not optimal for probably about 95% of the population. And what I'm going to do today is I'm actually going to show you my own index universal life insurance policy, and we're going to talk about it a little bit so that way you kind of understand what's really going on. After that, we'll run through some examples as to how to really make that work, and then I'll go over some more realistic options. So the first thing I want to do is talk about what is life insurance. And basically what life insurance is a contract between you and the insurance company. And basically for a small dollar amount every month, they promise that if and when something happens to you, they will give your family a large sum of money. This money can be used for funeral expenses to help your family continue their standard of living. Additionally, you could create a legacy, maybe pay for a grandchild's college or something of that nature, buy and sell agreements for businesses, or one more thing that I have here is assistance with assisted living facilities or end-of-life care. So a lot of these different policies have different purposes, so there's no one size fits all. And the best thing that you can do is actually educate yourself on the matter and figure out what is best for you. And one way to really think about how much insurance you need, what I tell people to do is to ask themselves, what are they trying to protect and for what amount of time? So you may have a life insurance policy from when you're 25, but let's just say, for example, you bought a new house and now you have a mortgage and you want to make sure that if something happens to you, your family gets to keep the house. You may want to take a 25-year term or a 20-year term to ensure that if something happens to you, then the mortgage will be paid off and then your significant other will not have to worry. Additionally, we have like decreasing terms. There's return of premium terms. So that way you get all the money that you paid into the policy back. So there are a limited amount of options out there. It's just really figuring out what you're trying to accomplish when you're looking at purchasing life insurance. So let's get into my policy specifically. I have here, we'll start at the top. So as you can see, the owner is me, Steve Isidore. And this statement is actually from March 20th of 23 till this year. So I just got this statement and I've had this policy for over 9 years now. I got it when I was 31. And I think my policy is a great example because I was a regular person then. I'm basically a regular person now. And most people, they don't want to spend $120 something, $130 a month or more on insurance. So in order to make these life insurances work as a retirement policy, you actually have to spend way more than that, and we'll get into that a little bit later. So as we scroll down here for some of the information, we can see that the death benefit is $156,250. So that's going to last me until the end of my life. So it's guaranteeing that I'm going to leave something behind for my kids. Additionally, and speaking about this 156, I actually didn't think, or when I got it, I thought it was enough insurance. I had a second child and then I realized it wasn't. So I supplemented it with a term. So I just want to give you like strategies that I'm using in my life. So that way you can kind of analyze what's going on in your life and apply it to your personal situation. It's a tailored suit. It's not one size fits all. So I did get an additional 20-year term that will last me until I'm in my mid-50s, which by then the house will be paid off, the kids will be adults, and my need for insurance will actually be decreasing. Additionally, like for my spouse, she'll have full access to the retirement account to spend on some young guy, hopefully not. So just to give you an idea of like how to think about these things as part of a financial plan and not the financial plan. So now if we're looking here as to what happened in the last year, some years I add a little bit of extra money. Last year I didn't at all. So for the total year, I paid $1,526.52. And if we look at here where it says accumulated target premium, so this is what's required to keep the policy healthy to ensure that it's going to last to the end of my life, which is basically the $1,526 per year. However, because I've added an extra couple $100 here and there over the years, I'm a little bit above that, roughly $2,300 more above that. So that way, like I'm slightly overfunding the policy. There can be dangers in overfunding it, such as modified endowment contract, but that's not for today. That's like above the scope of this conversation. And today, if I wanted to give up the policy, they would return to me $9,431. And there is a surrender charge. So basically a penalty that can last 12 to 14 years on these policies. So it's not like you just get all your money back. And the total amount of money that I've accumulated is $11,641.47. So as you can see, I spent $16,000, but after you subtract the cost of insurance, the total cash value for today is $11,000. To be honest, and this is why I say for regular people this doesn't really work, I spent $16,000 over the past 9 years. And if I needed to borrow money today, I could borrow up to probably the $11,000. And additionally, they're going to charge me interest for borrowing that money. So I think a lot of times people think they're going to be able to borrow the death benefit amount and not necessarily the accumulation amount. So I really want to make that distinction. And let's talk about what's going on in this policy. And just to keep it simple, we have a declared interest account. So basically, it's a fixed amount. When I first got the policy, I split it 50-50. So I took the fixed 4%, and then I took whatever the S&P 500 was going to return, and I took 50% of each. Somewhere in the past, I was like, well, that's stupid. I might as well just put it all in the indexed account because over time, the S&P will beat that fixed 4%. So to keep today simple, what I'm going to do is go over the totals as opposed to diving deep into the weeds there. So what you can see for the year, I was credited $828.73 for last year. So that's what this policy earned for me. However, the policy cost for loads and expenses, $621. And then for the cost of insurance was $202. So if we do some quick math, we can see that's $823 for the year. So realistically, I'm positive $5. So people would say, well, that doesn't really make a lot of sense. Like, what's the point of this? Well, basically the insurance is free now. And then it's become somewhat like a savings account. So provided that our economy maintains its trajectory, each year moving forward, that amount will increase faster than the cost of insurance. So what I really want people to understand is that when we're looking at these insurance policies, we should be thinking in terms of 20, 30 years and not necessarily in terms of I'm going to pay for 2 or 3 years and then borrow some money down the line. And one thing for people to keep in mind is that there's a cap on the amount they'll give you. So for example, let's say the S&P 500, it does 13% this year. Well, they've capped me out at 7.5%. So they'll get to keep the difference. So these are things that are never brought up on social media when people are talking about insurance. And I kind of wanted to bring up to give people a sobering and realistic understanding. And then this is the last page. There's not really much here to go over. I just wanted to show you that it's the last page. So what I really want to do now is kind of play with the numbers a little bit so you can see how this would work if you try to make it your investment strategy. So if you go here on Google, you can always just Google investment calculator and this tool will come up for you. And as we can see today, I'm going to put my accumulation amount and my starting amount. And I'm currently 40 years old. So let's say I'm going to save for another 20 years in this policy. The amount of return I got this year, I did the math beforehand. It was about 7.1%. But I'm going to be more conservative and use 6.5% because it's best to do that to set the proper expectations. Additionally, I'm going to add my annual contribution of $1,526.52. If I hit calculate, you will see my total contributions over the time will be $30,000 from now until the age of 60 will be $30,530. And the interest that I'll get maintaining 6.5%. And I use 6.5% as an average because some years it'll be higher, some years it'll be lower. You'll see that I will gain $58,116. Now, if I decide to work until 25, let's go ahead and change that to 25 here. All right, backspace. You will see that it'll increase to that extra 5 years will buy me an extra $46,000. As you can see here, the total interest will increase. So now that I've kind of played with this example, I really want you to understand like how to think about overfunding your policy. So let's just say every year you decide to add an extra $1,000. So we'll make it $25,2652. You hit calculate and now you have $204,982. So the way to think about taking money out of your insurance policy, preferably is through a loan if you haven't made it a MEC, a modified endowment contract. If it becomes a MEC because your death benefit your cash value exceeds your death benefit, then now you will have to pay taxes on that, and it just is what it is, right? But the way to really think about it, or what I would use as a strategy, is let's just say, for example, 204,000, let's just round it up to 205, right? And then I want to take 6% out every year. So then I would be taking out $12,300 every year. I personally, what I would do, depending on how life is at that time, if the market is up, then I will draw down from my IRAs. If the market is down and I need to buy some more time, maybe 2 or 3 years, this would then be somewhere that I would start to pull money out of. As you can see, the power is in the time. So if I could go through my retirement funds, let's say from 65 to 80, and then at 82, I'm dead broke, then let's go ahead and make that 42 years of growth. Oh, I'm sorry, let's fix that. Let's make that just a minimum payment at 42 years. Then we're looking at 471,000 in the 80s. And then if we take 471.186 and we start drawing down, let's say 7%, that's, I'm sorry, I did that wrong. 471,186, and we're going to take out 7%. Now we're looking at having an additional 32,983. So I'm hoping to give you an idea of how to really think about using life insurance as part of your investment strategy or retirement strategy. But I really think for 90% of people, you know, if you can't afford to put an extra $300-400 a month into these policies, I don't think it should be your investment strategy. I think you're probably better off working with a broker, or you're better off working with a certified financial planner, which I can make referrals for if you ask, to better plan out a retirement strategy. So if I'm saying Index Universal Life is not the strategy for you, then what is? I will go over some options here, and then we will take it from there. Give me 1 second. I went to the wrong place. So for most people, term life insurance, I think, is probably the optimal option, and then saving and investing, the difference in their money. So just to give you an idea of how affordable term life insurance is, I'm using a 25-year-old male in the state of Florida, and standard health or regular health. So this person is not like a elite, peak health, just a regular person. And speaking of that, you should try to get insurance as young as possible, because if you are diagnosed with a disease later on, or if you become grossly overweight, or you have some kind of accident where you're somewhat handicapped, you may become uninsurable until you're about 45, where you'd have to get final expense, which is completely terrible, actually. So just to give an idea on this $500,000, a 10-year term is $25 a month for the male, $20 a month for the female. A 20-year term is $32 a month for the male, $28 for the female. And a 30-year term is $56 per month, and then it's $42 for the female. And with term insurance, unless you're getting like a return of premium rider, it's really just like renting the insurance. If you outlive the term, the insurance company keeps the money and you get the difference. What you do get, though, is insurability. So no matter what's wrong with you, they have to write you another policy, whether it's a new term, depending on your age, or a whole life policy. But this is just for illustration, is not to get bogged down in the details. Additionally, what I want to point out is if you wait to borrow insurance, so let's say this young lady here, she wants a 20-year term for $500,000. If she gets it at 25 years old, you can see it's going to cost her $28. For a male, it'll be $32. At 35 years old, it is now $32, and for a male, it'll be $39. So not a big difference in that 10-year period. But as you can see, when we jump from 35 to 45, it's double-ish, depending on who you're looking at, because for the female, it is $66.30, and then for the male, it's $87.55. So like I said, with investing for retirement, with life insurance, with credit, pretty much everything that's important in life, the earlier you start, the better the results will be. And if you're looking for something that's going to last you till the end of your life, there are some policies called universal life policies. So basically, I think of them as extended term policies. And just to give an idea, if somebody wanted $250,000 for the rest of their life, or really until age 121, you're looking at $83 a month. If they wait till they're 30, it's $118 a month. If they wait until they're 40, now it's $167 per month. And if they wait until they're 50, then you're looking at $262.25 per month. But these policies will be built out until age 121. You could actually bring it down to 110 or 100, and that'll help lower the premium. And similar to the Index Universal Life, there will be some cash accumulation on the front end, and then you will hit a middle point, and then towards the back end, you'll have it where the insurance company starts taking back some of that the cash accumulation and the interest they paid you. And what they do with that is they help keep your premium stabilized throughout the term of the life insurance. So if you found this informative, if you learned something, go ahead, hit the like, share this with anyone you think could use this information. And if you're in the states of Texas and Florida for now, I can help you mostly with Medicare, Obamacare via Blue Cross and Blue Shield, and with life insurance. I work with a brokerage, so I can represent a lot of different companies to find you the best deal. I think the biggest takeaway I would say for this video that I hope that you got is to realize that your life insurance needs are going to be unique to your specific situation, and it's best to invest the time to do something that's going to help you accomplish your needs and goals, as opposed to just thinking it's a one-size-fits-all. And if not anything, I hope that I kill all this noise on the internet where they're trying to show everyone that this one-size-fits-all strategy is great. Unless you have a couple $100 or $1,000 a month to overfund it, it's really not going to work for like 99% of people. Thank you.